Welcome to the show, Seth.
Thanks, Aisha. Appreciate you having me. I'm glad to be here.
Absolutely. So let's start with, can you help us understand what a private banking strategy is?
Sure. Private banking strategies is a cornerstone of asset protection, tax-free growth, and a financial system which we believe should be in every American household. And like you mentioned, it was a tool that's been used for centuries, but with the invent of branch banking, it's kind of taken a little less known pathway. And a gentleman named Nelson Nash, who's kind of one of the OGs or grandfather, forefathers in bringing infinite banking back to the forefront, brought it back in the 70s and helped start educating people on how to use it. So it's a carefully structured contract that you use with whole life insurance companies and very particular life insurance companies because they're not all um, versed at how to use this contract for a banking vault. But effectively, you use this contract just like you would put money in a bank, and you're able to have complete liquidity. You're able to have tax-free growth and compounding growth within that contract. You're able to capture privacy aspects, which are not you can't capture with a normal bank. So the fundamental basis is the contract with the whole life insurance company. And you fund these contracts, and then you're able to utilize that money and get multiple touches on the same dollar.
So you're able to fund it, say, as if you're depositing money into a bank, or is it like a life insurance policy, $10 million policy that you take out?
Yes, it is a life insurance policy, and you do have certain things like death benefit, which transfer wealth tax free, but that's not the real fundamental banking application for the policy. The policy acts as a warehouse. It acts as a place where you can protect money and where you can access that money with complete liquidity, unlike retirement programs, 401ks, 403Bs, and other qualified government plans have very strict rules with when you can access the money, when you can take it out. There's penalties if you take it out too early. There's penalties if you take it out too late. And of course, there's always taxes when you take it out. So contrast that with a carefully crafted insurance contract that we're talking about as a cornerstone for your private banking strategy. There is no penalty for taking money out early. There's no penalty for taking it out too late. And most importantly, there's no taxes. There's no taxation on your money in or money out as from this policy. Of course, you pay taxes on income, but once the money is inside your policy, inside your private banking system, there is no taxation. And that's why folks that use this for centuries, and we're talking about, John F. Kennedy, we're talking about Pampered Chef founder, we're talking about Ray Kroc, who established McDonald's, J.C. Penney's, some major brands that every American knows. Those companies were started with the private banking strategy and the whole life insurance contract in place.
Okay. Maybe, in your book, your ebook, you talk about how banks use money and the flow of money um, as a foundation to understanding this strategy. Can you go into that a little bit so our viewers can understand?
Sure, I'd love to. So, like I said, in the 70s, Nelson Nash brought what he coined the infinite banking concept, which is the use of a whole life insurance contract to serve as a banking system for your family. Well, branch banking became very big in the 50s and 60s, where you effectively have a neighborhood bank, things that we know today as Wells Fargo, Bank of America, Chase, US Bank, all those brand name big box banks, which are on every corner, and they make it convenient for you to deposit your money. Well, those banks are regulated by certain laws, and they're able to do what's called fractionalized lending. And fractionalized lending means that if you or I bring in $100,000 into that bank, that they are able to take a reserve, a piece of that, and we'll call it 10%. But large banks who have more deposits than others are able to actually reserve less than that. So they take that $100,000 that you deposited, and they effectively only keep 10,000 within their walls, so to speak. They loan the other $90,000 of your money out for someone to go buy a home or a car or a business loan. And they're making interest on money that they effectively never earned. You just decided to put that money there. Well, that's called fractionalized lending. And it works so long as you come in and you need your $100,000. So they scrape together 10 other people's $10,000 that they had reserved, and they give you that. But if all the people, all those 10 people come in and want their money back, that's called the bank run. The bank is insolvent. And unfortunately, that's a bad economic policy for you and I, and a bad place to keep money when your bank effectively fractionalizes our deposits and we don't have the money there. And you may recall in 2012, there was a financial collapse in Cyprus, and there were bail-ins. The bank actually bailed in on the depositors' money, and that was an authorized, legitimate, legal way for them to operate. And people go, well, that will never happen in America. It actually is, it's already laws on the books, and it's called the Dodd-Frank Act, and misnamed, in my opinion, as a Consumer Protection Act, because it does nothing to protect you or or the public at large deposits. And effectively, the Dodd-Frank Act, what it does allow banks to do is to take the deposits, of cash on hand and effectively become solvent. And in return, you get perhaps bank stock, or you may get pennies on the dollar, and that's your exchange. Well, next issue that comes up always is FDIC. What about FDIC insurance?
I was going to mention that. Yes.
So if you've got, more than $250,000 in your particular account, that's the ceiling for FDIC insurance. But if you actually dig into the solvency of the FDIC, you'll see that there's not enough assets on the FDIC. And this is published information that anybody can research. And they have about 25 billion in assets as of the end of last year, 2022. And there's about almost $20 trillion worth of deposits in American banking institutions. So you've got 20 trillion deposited, and you've got 25 billion that's allocated to insure that 20 trillion. You and I don't have to be mathematicians to see that that doesn't add up. There's not enough assets in the FDIC to actually make good on the insurance of those deposits. In fact, it's less than a penny per dollar. So that's quite shocking when you begin to dig into that. And some people go, well, do I really believe that? Is that even possible? Well, I'd sent you a clip from an FDIC committee meeting, which those folks were roundtabling the very issue that we're discussing.
Just a few months ago. Yes.
It's quite shocking. There's a roundtable of FDIC bankers and a special committee, and they're discussing the
Crisis mode.
Yeah, they're in crisis mode, and they're discussing the insolvency of the FDIC and the potential catastrophic economic policy that's been created with the printing of money and the inability to insure those deposits. And they're saying things like, we want to control the narrative. We don't want the public at large to understand the potential collapse of the banking system. and they want to control the narrative in the social media. They want to control the narrative in the mainstream media to put people at a false ease and thinking that your money's totally safe and completely insured. And if you've got your thinking cap on, you'll I think most people will agree it's not a safe place, and there are alternatives. You don't necessarily have to play in that sandbox, and you can create your own banking systems where you've got more assurance and safety.
I mean, putting the potential collapse aside and not being insured for your money, putting that aside, even leaving in the bank money in the bank with the low interest rates makes no sense.
Of course, yeah, you're not getting paid anything to keep your money sitting there at the bank.
Absolutely. So can we talk about private banking, your system that you advise your clients on, and how that relates to real estate investing? What are some of the things we can do with that?
Absolutely. One of the pillars of private banking strategies we call the velocity of money. And that's putting your money to work and actually getting multiple touches on the same dollar, being able to use the same dollar more than once. And it doesn't work in any better format or structure than real estate. Real estate is a perfect hand in glove way to use private banking. And let me just illustrate that to you for a moment. So let's say that you capitalize your private bank with $100,000. And just for the simplicity of the example, you funded your bank. Let's call that a new business, a banking business with $100,000. Now you want to take a loan out of your bank and go purchase a piece of real estate. So you borrow that $100,000 out of your bank, and you go and you acquire an income producing property. Let's call it a duplex. Okay.
Mhm.
A little duplex. And let's say that it spends off $1,000 a door. So 2,000 a month or 24,000 a year. Okay. You bought this property, a duplex, you've got renters, and you're making $2,000 gross a month. At the end of the year, and we're not going to analyze all of the various maintenance and
The debt service.
debt service. We're just going to keep the gross numbers on the top sheets just for a simplistic understanding. You take that $24,000 and you begin to pay down your bank's loan. And so remember, you're the bank and you're the borrower. So you're not only making money inside your policy where you borrowed the money, and it's compounding and growing tax free, no taxable event taking the money out or putting it back in, no matter what interest rate that you charge yourself. You can effectively crank your interest rates up, and you've got more growth potential. And that money in there is available at the end of the year. You've paid down 25% of your loan at the end of first year, and you've got this income producing property still spinning off 24,000 a year. Well, at about the end of 4 years, you've paid your bank totally back. And so you've got 100,000 plus the compounding growth, plus the interest and dividends that are paid on those sums, which we'll call it between 6 and 7% per year. And that's tax free. So compare that with other investments which have a tax um, event, a tax liability. This has no tax liability. That is kind of the simplistic example of how you would use this to partner with yourself in real estate. And once you've got enough cash in your own banking system, Aisha, you're not beholden to third party financing. You're not beholden to loan applications. You're never going to default because you're the borrower and the bank, and you're able to renegotiate terms. If you've got a slowdown in rental income, then you can adjust your mortgage rates. But at the end of four years, you've effectively got no cash into that property, and it's spinning off 2,000 a year. So that's effectively how you might use it in real estate.
So you can dictate your own mortgage rate, or does it just depend on the government rates? How does that work?
No, you are the banker and the borrower effectively. They're set up with different entities, but you are in control of the terms, and you're in control of how long the term is, the interest rates. You can renegotiate those things whenever you want, across the table from yourself. And it's quite easy because you're the one in control.
Right. And, but not everyone, say you're a first time real estate investor and you've never bought a piece of real estate, not everyone is going to know how to do that. So would you work with your clients to help them figure that out?
Of course, sure. Yeah, absolutely. But it's not quite as complicated as it might sound. I mean, you effectively the money is yours to access. It's fully liquid. There, it's about as easy as telling the life insurance company where you want them to wire money. And so from that point, you can put your money back in the bank on a monthly basis, on a quarterly basis, on a yearly basis, but it's at work for you. And that's the important part, is you're capturing the velocity of money. You put the $1 in to your bank, you borrowed a dollar out, you bought a piece of real estate with that dollar came back to you in rental cash flow, and then you paid your bank back with that same dollar. There's a cycle there where you're getting multiple touches on the same dollar that you only earned once. You earned that dollar one time originally. You capitalized your bank, and then you put that money to work 5, 6, 7 times. And you can do the same thing in any type of business scenario. If you've got, let's say that you're a farmer and you need equipment and you need to continually purchase equipment, you can use it with auto financing. You can use it with any type of asset or any type of inventory in business that has cyclical return and has a cash flow opportunity. What you don't want to do is just eat your seed, as I like to say, and where you don't put it to work for yourself. You don't just consume the money, you put it into a return, something that's producing a return, something that's producing a cash flow.
Absolutely. Now, if we want to lend money, say as a lender, for someone else to go buy real estate, can we do that as well from your account?
Sure. Yeah. I mean, you could use the money in your private bank for any purpose. There are no restrictions or limitations. I mean, and this is the banking side of the equation. So there's some series that we've done called the Paul Bunyan parts 1, 2, and 3. And what it does is analyze a gentleman who was in the forestry business, and he was financing all of his equipment through third parties. And he began to implement the private banking and bought one piece of equipment, financed it through his own bank, then 2, then 3, then 4, and created that system where all of the money that he has in his own banking system, he was able to fund his business needs, his operating budget for his business through that as he grew. And then ultimately he went out and began to finance other forestry businesses for their equipment financing. And he ultimately got out of the forestry business and became a banker, complete banker through his own private banking system, because he had began to amass that much wealth. So it's quite doable. And there are many folks that become, they transition out of their core expertise, whatever it was, whether it's chiropractic business or forestry, and they become bankers.
Now, what if you want to purchase something and there's not enough money in your bank? Can you team up with other people to say you, for example, you want to buy an apartment building? The people that you team up with, do they have to have a life insurance policy as well? Or does it not matter?
No, it doesn't matter. I mean, if you're going to syndicate real estate opportunities into a group, your interest or your part in the deal, you can fund through your own private bank. It doesn't have to be the entire chunk of the acquisition. But at the same time, you can't use what you haven't put into your bank. So you're not going to be able to borrow out of your bank what you haven't put in. So, if I've got $100,000 and I can buy a duplex, I can't buy $1 million apartment complex.
Right. Now, we're running out of time, so I want to ask you, do you have any advice for our listeners out there, for someone that maybe that hasn't started their wealth building journey or hasn't started investing, do you have any advice for people?
Sure. I think that it's critical that you get educated and that you do your due diligence and your research, and begin to make those decisions now. And procrastination is not your friend. One of the things that we like to illustrate with these plans is, as folks begin to put them in place for their family, that the generational wealth that's created from one generation to the next to the next is quite amazing, frankly. And it's from doing nothing other than putting the steps in motion. And that's if you don't even you don't have to be a real estate mogul or make the best investments ever to accumulate that wealth. It's simply putting the money in place in your banks and letting it compound and grow tax free year after year. It's the tax-free aspect of it, Aisha, is really quite amazing. And it's, if you want to dig further into the carve out, it's Internal Revenue Code 7702 as to why it's such a powerful tool. That's why like I mentioned, a lot of the wealthiest people that we know and hear of are using private banking to establish that wealth.
Like I always say, it's not how much you earn, it's how much you keep. And it
That's right.
sounds like from your life insurance policy system, it's very advantageous for that.
That's right. Yeah, and you need to when you get started, the procrastination in a compound curve is one that hurts you most at the end. I don't know if you've ever heard this said, but it's in our book, and we talk about a penny doubled over 30 days and what it actually comes out to. And it's funny, I tell this story because my partner Vance and he said, you double a penny every day and see what you come out to, and it'll come out to over $5 million. And I thought, that's impossible. So I start to do the numbers in my head, and day 15, 16, I'm like, this is no way it's going to get to 15 million. But as I kept going and got into the day 23, day 24, you realize this picks up the most steam at the end. And so inside your banking system, that corpus of principle, year 1, year 2, year 3, it's building steam. But in the at 20, at 30 years, at even 40 years, it begins to double. And so you've got, you go from 2 million to 4 million to 8 million to 16 million, and it actually becomes parabolic. So the procrastination, what we say is, hey, educate yourself. And if you want to do this, take small steps, dip your toes in the water, and start to put it in practice, because in 30 years, it's going to have a massive effect. And in 40 years, it's going to have even more of a massive effect. So procrastination.
Yeah, I think though, for our listeners that may be further up in age that don't have a very 40-year investment horizon, I still think, and do you agree, it's still never too late to start with something like this if you haven't done anything?
Agreed, absolutely. And that's why we have 7 fundamental pillars, and you will address like asset protection. We touched on that, why you're not earning any money in a centralized bank account at Wells Fargo. You're not, and your money's not safe. You've got retirement programs, but you're paying taxes. And I don't think those taxes are going to decrease. I think they're going to increase. So if you're using things for a tax strategy and you're older in sunset years, you need to be able to count on what you think you have. Well, IRAs and 401ks are not secure, in my opinion, because of the tax issues, and where you've got these alternatives. So it depends on what your purpose is and what your fundamental need is. But agreed, it's never too late to start. I was simply just talking about it, for the younger listeners out there, the folks that are 30 to 40-year age group, you will be amazed at what your wealth can do for you inside this system without working any harder, and only changing who gets the money, meaning your own bank.
Right. You just made me think of was it an Einstein quote? Compound interest is the eighth wonder of the world.
Yeah, that's it. That's exactly what I'm talking about. And that's what he's talking about, the amazing power of compounding interest.
Fantastic. Seth, thank you so, so much for your expertise in the information that you shared from us. I'm looking forward to having you back on the show so we can dive a little deeper in the future for the next episodes.
Love to, Aisha. Thank you for having me. Really appreciate it.
Thank you very much.